Great. Well, let me give a brief introduction, give a little overview of what the Motus program is here for, what we what the problem that we solve. We'll talk about the coverages that we offer, the package that we have for RSJ, and then I'll try to get quickly to Q&A if I hope that makes sense. So the idea of the Motus program is that every condo association out there, whether it's townhomes, condos, co-ops, any similar structure, they all have a full coverage master fire insurance policy at the HOA level, but only about 1% of condo associations carry a full coverage master earthquake insurance policy. And so that means that the HOA absorbs the risk for fire damage, but individuals absorb the risk for earthquake damage in the form of a special assessment. So if there's a major earthquake and there's a lot of damage, the HOA has the responsibility to make major repairs, but without that master policy, they pay for those repairs with a major special assessment. And that assessment is what we're most concerned with. And I'm going to skip around here a little bit. I can go into more detail if necessary, but this chart really captures the core problem with the California earthquake insurance market when it comes to condo owners. If you have, if the HOA has to make major repairs, the bill could easily run into the hundreds of thousands of dollars. It will come to you in the form again of a special assessment. The big problem is that the most coverage you can purchase as a condo owner for an earthquake-related special assessment is $100,000 of coverage. The CEA can get to $100,000, and that's who you would get through your State Farm or your CSAA or AAA or USAA homeowners policy provider. They repackage CEA policies and offer them to you. So you can get $100,000 through them. There's another private company that does 100,000, and then it's downhill from there. $100,000 as a cap is a fraction of your share of rebuilding. And that's the core idea that we set out to solve with the Motus program. In a nutshell, what we do is we design what would be a full coverage master earthquake insurance policy. We design it specifically for your association. We go through all the steps that you would go through to create that full coverage master earthquake insurance policy. But instead of making it an all or nothing decision at the HOA level, where everyone pays for it and everyone gets the coverage, or no one pays and no one gets the coverage, we allow each individual unit owner to purchase his or her share of that master policy. That's a general description. There's a lot more flexibility built in, but that structure is why we're able to offer enhanced or extended coverage relative to these other options, because you're buying a share of a custom designed master earthquake insurance policy. So let me get right down into it, into the materials that we've offered and tell you what that looks like. So this is our estimate of your share of rebuilding at RSJ. So it's a very simplified number where we take an estimate for the total cost of rebuilding the association. We divide it by the number of unit owners. And then with a little bit of rounding, we get to this number of 390,000. Happy to go into detail on where that comes from or detail beyond that, but that's how we design our programs. Now, that's just a starting point, okay? That's what we call the estimated unit exposure. You can buy more coverage, you can buy less coverage, but that's the starting point. And the big takeaway here is that we can offer that amount of coverage. You can buy full coverage with Motus because you're getting a share of that custom built master policy. Our cost for this level of coverage is about $900, and that's with a 20% deductible. Talk about deductibles and options when we get down to a later page here. But that's just call it the starting point. Now, in addition to offering much more coverage than other options, we also have more complete coverage. We cover the special assessment portion that's related to residential buildings, as does CEA, but that's really from there on out, CEA has a lot of exceptions, exclusions. We cover damage, the assessment related to common areas, any sort of parking structure, foundations, underground pipes and plumbing. All these elements are included in our coverage, but there are many exclusions in the CEA policy around those elements. Finally, we include unit interiors, and this is a big bucket that is treated as a separate bucket by other products. So with Motus, if you buy $390,000 of coverage, that could go towards a $390,000 assessment. Or in the case of a smaller earthquake, it could go towards, for example, a $200,000 special assessment and leave $190,000 for your unit interior. Now, unit interior, for the purposes of any sort of homeowner's insurance policy, it means anything permanently installed in the unit, including any improvements, and also including any major appliances. You can think of it in a non-legal sense as stuff that stays there if you move out. So your washer dryer, even though maybe it's not completely installed in the unit, tends to stay there. That's considered part of the unit interior. So this $390,000 of combined assessment and interior coverage is really the core of what we offer, and what we do that is, we think, a whole lot better than what anyone else does. With CEA and others, you can buy well, CEA up to $100,000 of assessment coverage, and then separately you could buy up to $100,000 of interior coverage, but they're separate buckets. Each comes with its own deductible. And if you run out of dollars in one bucket before you run out in the other bucket, you can't move the money around. A single combined limit coverage to us is a superior way to buy earthquake insurance. So that's really the core of the Motus program. We also offer the traditional, call it side dishes, when it comes to earthquake insurance of loss of use or rent, in other words, alternate housing cost coverage, and personal property coverage. Personal property, the contents of your unit, that picks up where the interior leaves off. So consider that to be primarily clothing, furniture, and small appliances. I say that because glasses and dishes and things that can fall off shelves and shatter are excluded. That's not unique to Motus, um, as are unique works of art. So if you can't replace it with a quick internet search, then it's not going to be covered by this generic policy. If you bought something nice at auction at Christie's, or maybe less nice at a local flea market, if it's that unique type of item that you can't replace commercially, it's not eligible for this generic coverage. So that's our add-on, but really this is what we focus on. This is what makes us special. It's our full or enhanced special assessment coverage designed for your community, priced according to your risk. That's what we focus on. Uh, so let me jump to the enrollment form, talk about a few other things here. This program, first of all, Motus Insurance Services, just to be clear, we're a broker. We are not an insurance company. And what that means is if it comes time for a claim, we sit on your side of the table and we help maximize your recovery. The company who backs the program, in other words, the actual insurance company behind the program, is listed here, rated A excellent by AM Best. AM Best, if you're not familiar, is the gold standard of ratings agencies for insurance companies, and that is a very good rating. The California Earthquake Authority is actually rated two notches below. It is not formally backed by the state government. It's simply created by state law, but it is rated B++. So it's a highly concentrated set of risks that does not have adequate reinsurance behind it to earn the A rating. So just a point of comparison there. The Motus program is on an October 5th cycle, meaning the program begins and ends each year at 12:01 a.m. on October 5th. So we're right now in the open enrollment period. The effective date of October 5th essentially operates as a deadline. So in order to take advantage of the full year pricing within this packet, it's anticipated that you would sign up before October 5th. You can always cancel partway through the year and get a refund for what we call the unearned premium. In other words, a prorated refund of your premium up to a maximum refund of 75%, simply because 25% is due to the carrier up front. And also, if you miss the deadline, you can always come to us in 6 months and we can offer you terms for the remaining 6 months of the program. But there is an $85 additional late enrollment fee. So this is not the end of the story, but certainly intended that you sign up during this open enrollment period. The deductible is 20%. I will talk about that and how to translate that into dollar terms in a moment. The next section, property owner information. This is mostly your contact information. The only thing that requires a little bit of a mention is the insured. If you hold your property in trust, give us that extra information. The ownership of the property should reflect exactly what's on your homeowner's insurance policy. So I would consult that and mimic that wording. The property to be insured, if it's different from your mailing address, is in the next block. And then we get down to the insurance coverage options. So as you can see, we have one lower level of coverage listed, the base amount listed, and then a couple of higher levels. Now, it really is entirely up to the individual. Partial coverage, 250,000 or going down to 100,000 online, is certainly an option for those who don't think they will ever have to face the full cost of rebuilding. 390,000, we've talked about that. That's our baseline and talked about where those numbers come from. And then reasons to consider more coverage. Number one, Since this 390 is the estimated average owner exposure, you may not be average. If you have a larger floor plan, and if your association allocates assessments on the basis of floor plan or square footage, you may want to purchase more coverage. If you've made extensive renovations, remodels to your unit, you may want more coverage. As we talked about, our coverage applies to improvements. And so if you do have some additional work done on the interior, you may want more coverage to help replicate that. And then finally, we have this word estimated, and this is kind of the big one because we do start with a good faith estimate that's been accepted by the insurance carrier as to the total cost or total estimated cost of rebuilding the association. But as I'm sure you can imagine, if we're trying to rebuild completely in the aftermath of a major regional catastrophe where everyone in Orange County is trying to hire a limited set of general contractors, trying to buy a limited supply of building materials, costs will go up. And if those costs go up, they will be passed on to you through a higher assessment. So that's another reason to consider more coverage. Now, so those are the reasons or the ways to think about coverage level. Now, finally, let me overlay the deductible because the deductible is explicitly based on the amount of coverage that you purchase. It is not based on your financial loss after any given earthquake. So if you buy $500,000 of coverage, you have a maximum deductible exposure of $100,000. So if there's an earthquake, and if maybe there's just some cosmetic cracks in every building, need some spackle and some paint, but nothing structural, and maybe everyone gets assessed $1,000 for their share of those cosmetic repairs. This insurance will do nothing for you. This is not here to pay $800 out of that $1,000 assessment. This is here to pay for the major repairs that go beyond that sizable deductible, 20% based on the amount of coverage you purchase. And so if you're on the fence of thinking about, well, do I want $400,000 of coverage or do I want $500,000 of coverage? Take into account, of course, that it's 500 is more expensive, but also understand that you're increasing your deductible exposure by $20,000 with that move. Now it's a big deductible. I'm going to give you just a little extra information on that. We don't normally go into this detail in the open sessions, but that maximum deductible, 20% of the 500,000, that only applies if every single building in the association suffers damage. Building, not unit, building. So if every building suffers damage, then 100% of that maximum deductible applies. But your association is made up of over 100 buildings. So if, for example, 57 buildings suffer damage, 50% of the total building count, then only 50% of that maximum deductible applies. So there is some scalability in the deductible. Don't be too scared off by that sort of six-digit exposure. If it's a smaller event, the deductible will likely be smaller, assuming some buildings are affected and others are not. I know that's a little complex, but remember a few things that are important. Number one, your deductible is based on the amount of coverage you purchase. Number two, the deductible is the portion that the insurance company is not responsible for. So it's that goes first, but it doesn't decrease your maximum recovery from the insurance company. In other words, if you get an assessment of $1 million, yes, you have a $100,000, maybe you have a $100,000 deductible, but after that, the next $500,000 would get paid out by the insurance company. So the deductible comes first, but it does not decrease your maximum recovery from the insurance company. So those are just a few details on the deductible. Briefly on the combined loss of use or rent, it does have a separate deductible on it, which is structured the same way, except there's no partial building count adjustment. If you buy $100,000 of this coverage, the first $20,000 of your loss would be your responsibility. Maybe that's 4 months at an Airbnb for $5,000 a month, who knows? But that's your responsibility. Once you've met the deductible, the next $100,000 will be paid out by the insurance company. If you're signing up using this form, then simply check off the boxes of the coverages that you would like, send a check in to our main office in New York, and you are done. We will send you confirmation when we receive it, and you'll get your certificate of insurance by email. If you prefer to go online, you have a lot more options. You can pick intermediate coverage levels, like if you have your heart set on $450,000 of coverage, you can do that online. If you would like to take a look at other payment options, you can pay over time. We have a 9-pay payment program where you have a down payment and then 8 additional payments. Each additional payment, though, does come with an administrative fee of $14, so you end up paying an extra $112 for the year. Now, that's a relatively high number based on percentage, but it's also, I suppose, lower than financing it with a credit card. So that's an option online. You can also pay by credit card, by direct ACH transfer from your bank. All those direct deposit, those are all available online as well. And just to wrap up, if you have, because I'm through the basic materials that I wanted to go through, but oh, sorry, to get online, you would go to app.motusins.com and use the HOA code RSJ612. The 612 is from your zip code. It's how you identify yourself to our system as a member of Rancho San Joaquin. If you have any questions that come up that hit you after our conversation here today, call us or email us. Our contact information is at the bottom of every page. We have a team that is based in California, Idaho, Michigan, and New York. And so we tend to pick up the phone certainly during Pacific business hours, but also a bit on the early side if you're interested in speaking with us earlier, including one of our team members who's actually in Orange County. So we are here to help if questions come up later. But for now, I'm very happy to take any questions that are on your mind. I think you're still muted, Mari. I hope I didn't do something.
There we go. Sorry.
There it is.
Thank you. Thank you, Alex. I'll go ahead and open up the questions, but I'll go ahead. I do have one question. In a past presentation, you talked about where our condo buildings are structured where it's possible that an earthquake would cause, like, say, half the building to collapse, and then you got the remaining structure still standing. But say the engineer, in most cases, are going to require that the entire building be demolished because structurally it's all one building. You talked about how CEA coverage does not pay for rebuilding the entire building, only half the building, because technically half the building was still standing after an earthquake.
Yeah, what you need in this case is ordinance and law coverage. And you need full ordinance and law coverage. In other words, you need 100% of your insurance proceeds to be able to apply in that case. This goes to the idea that there's indirect and direct damage after an earthquake. Phase one, the direct phase, is what we all think of. As you described, the earth shakes, causes damage to the building. But phase two is very important and is a very regular occurrence where, just as you said, an engineer inspects the building, even if it looks like it's mostly intact, but says, well, look, due to the damage to the foundation, I know you have a bid from a contractor to repair it, but you can't do that under local laws. I'm going to say you have to tear this building down and rebuild from scratch. And so you might have 50% of the building damaged directly from the earthquake and 50% effectively caused by the enforcement of local law. So we include full ordinance and law coverage. So every dollar that you buy can go towards a portion of the building that's not directly damaged by the earthquake. We also include what's called increased cost of compliance. In other words, if you have to replace, for example, single pane windows with double pane, you actually are covered for that with our policy. Now, I believe the CEA does have limited coverage for ordinance and law. And no matter what, if you're capped at $100,000 of coverage, you're going to end up probably using it all in a case where buildings are being rebuilt completely. But it's an important consideration. When we look at the big three, and I only really spent time on the first of the big three, but the big three to us are number one, you need to have full special assessment coverage. That's where we talked about with that chart that showed the cap on coverage of 100,000. Number two, the inclusion of common areas. And I talked about the idea that CEA and others will exclude certain elements of the assessment, like common areas and underground pipes and plumbing. And then number three, in our view, is this full ordinance and law coverage. If you're capped at $100,000 of coverage, it's less of an issue because if you're rebuilding, you're going to use all that. But it's an important element to make sure if you want to be fully covered, that you consider that indirect aspect, that's a very important piece. I don't have the exact terms of CEA's ordinance and law coverage handy, I'm afraid, but I know they do include some, but no matter what, it is not complete coverage for that ordinance and law bit. So if you're comparing and contrasting with the CEA or any of these other products available to you through your personal insurance broker, Ask about ordinance and law coverage. Make sure that you understand how much of that is included with any product that you're looking at.
Thank you. Anybody else to hear? You can unmute yourself if you want to ask a question.
Yeah, hi. I was wondering, God forbid there is a big disaster, God forbid, right? And a lot of damage to a lot of buildings. We've seen in recent years that some insurance companies, not earthquake, others fire and whatnot,
Mhm.
they go out of business or they don't have enough money to pay the owners and they take years sometimes to pay partial and things like that. What is the insurance behind your insurance?
So
Uh,
this is where the rating of the insurance company and its rating come into play. So this is Palomar is based in San Diego. This is not a Bermuda operation, which I know can set off some alarm bells. So this is a U.S. continental U.S. based company. The insurance group, actually, the holding company is listed on NASDAQ, and so you can certainly read up on Palomar Holdings. But the actual insurance company, the subsidiary that backs this, has this very strong rating of A excellent by AM Best. It's no guarantee that there is no scenario where this insurance company might not be able to meet all of its needs. But bear in mind that this is a company that writes a number of different types of risks, not just earthquake. So their premium comes from many different areas. They are not just California, and certainly not just Orange County, so very well diversified in the state of California and well beyond. So you're looking at a highly rated company with distributed risks, very solid reinsurance behind it, and that all combines into this A excellent rating that you see on the page. So I think it is the right question to be asking. If you're looking at catastrophic insurance, you are in part making a bet, not just on there being a catastrophe, but of that insurance company surviving the catastrophe. And the best assurance that we have on that is the A excellent rating from AM Best. So do read up more. You can create a free registration on the AM Best website, and you can read up on this insurance company. That would be my advice if that's the piece that is sticking for you.
one more question. Thanks for answering that.
Hmm.
The deductible 20%, can somebody buy down this? Like, if I want 10%, so what is the cost gonna be, or it is set in stone?
You can't through us at the moment. What we can do for you, and what you could also do through your personal insurance broker, is we can actually offer you one of those traditional earthquake insurance policies. So if you go to the CEA, for example, and you bought, let's say hypothetically, $50,000 of special assessment coverage, also with the 20% deductible. Those have no overlap in that maximum deductible case. In other words, let's say you have $500,000 of coverage with Motus. So under Motus, the first $100,000 is considered deductible. So if you also have this $50,000 20% deductible CEA policy, then the way that stacks up is the first $10,000 is deductible under the CEA. The next $50,000 gets covered by the CEA, and that leaves an additional $40,000 gap before the Motus program kicks in. So you've effectively reduced your deductible exposure from $100,000 down to $50,000. So that is an effective way to do that. It's also complex and a bit more expensive, but as you start cutting into the deductible, you will find that you're paying more per dollar of coverage, certainly. That's just the nature of earthquake insurance. Each incremental dollar of coverage effectively costs a little bit less because it's further from the risk. So you can look into that as an option. We can help you. We actually have access to both of these products, both this Palomar-backed program, which is the individual option that matches up with your homeowner's policy, as well as the GeoVera option here. So we can help you look at both of those options if that's something you're interested in, or if you just want to speak with your personal insurance broker and have them walk you through your options, you can do that as well. But at the moment, we don't have a multiple deductible options in the Motus program.
So you're saying CEA is another insurance?
The California Earthquake Authority is the most common earthquake insurance product in California. The CEA was created by government statute when the whole market fell apart after the Northridge quake. All the insurance carriers stopped offering individual condo owners earthquake insurance, and so the state created basically this authority to offer earthquake insurance as a companion policy to your homeowner's policy. So you could certainly go look at CEA through your whoever sold you your homeowner's policy, your HO6 policy. They have to offer you or make available to you the California Earthquake Authority earthquake add-on. So they're the ones who would offer that to you.
Mm.
We can help you look at some of these other options, but that's what you could look at. We to some extent they're a competitor of ours, the CEA, but I mean as you can see, your exposure is 400 to $500,000, and CEA can't offer more than 100,000. So we have a good relationship with the CEA. They're very nice people. They know their limitations. We worked with them quite a bit as we created this product, actually. Um, but the product isn't really helpful for protecting you from a true catastrophe, a large scale loss, but it does have its uses in a way to sort of fill in a little bit around the edges of what we offer.
Hey,
One last question,
oh, go ahead,
just
Tahir.
yeah. So the regular insurance doesn't pitch in catastrophes like that or in any situation like that, right?
Your standard homeowner's policy will exclude flood and earthquake damage.
Mm,
That's right.
right.
So it's a package of fire and lightning and liability. It's sort of the HO6 policy is a nice little neat package. But the big gap when it comes to Californians is earthquake, and then depending where you live, flood. So that's where these add-on products come in.
Thank you.
Mhm.
Hey, thank you, Tahir. Kathy or Ford, do you have any questions?
Hey, Alex,
Yes.
I'm just curious. The increase in, or like my homeowner's insurance took a big jump last year, and I'm looking at yours, and you guys seem to follow. I'm just looking at like the appreciation of our home. Do you
Hmm.
typically follow that? Is that how you are raising your prices, or?
Yeah. Two components. That is one of them. So we will every year revisit the stated valuation. Our insurance carriers have evolving floor valuations. I think when we first did the program, let me see if I can pull it up quickly. Um, the first year that we did the program at Rancho San Joaquin, the underwriting was based on, well, actually not, it wasn't not absurdly low. I think you guys had some good data, and so we had it at $213 a square foot, and that's all in, like all space, parking and residential. Parking may not be relevant here, but that's the number that was used. And now we have the valuation. We do have to revisit that every year with the insurance carrier, and right now we have you at $235 per square foot. And next year, it sounds like the floor will be $240 a square foot. So that insurable value number will go up. So, that 390,000 that you see on the page this year, the first year we ran the program, that number was 350,000. That's how the math worked out. So that's one element. So you have the increasing cost of or estimated cost of rebuilding. So that's an inflation-driven number. And then you have the cost per dollar of coverage, which is more like it's less like inflation and more like it's linked to interest rates in a way, because that's a return on capital for the insurance company. So how much do I want to charge to reserve this capital given what I know about the risk? We saw a big spike in what insurance companies charge per dollar of coverage back in 2023. That was when we really had to push hard and make it through sort of I think a tough renewal year, and including a change in deductible to help manage those costs. So there was that was a big system shock there. On the heels of that, we did start to see the insurance companies really say, "Hey, we had HOAs on the books that had $185 per square foot rebuilding costs, and you couldn't rebuild a doghouse in California for $185 a square foot." So that's the other that the the basis, the replacement cost estimate has gone up. So the amount of dollars that you're being told is your full value, and then the cost per dollar of coverage is the other element. This year, while we have increased the estimated cost of replacement, I don't think there was a major hit. Might have been a minor one. I think a minor increase, but relatively stable cost per dollar of coverage this year.
Thank you, Alex.